Hi everyone, sorry about the delayed start. Just waiting for a few more people to join the webinar. Ready? Okay. Thanks for joining the webinar, everyone. Today we're talking about common trends your professional advisors are missing or not telling you about. So I'm joined with my colleague Henry, who is a senior advisor within the tax team. I'm Venetia Benjamin, head of accountancy here at Fusion. My team mainly look after anything that you'd expect a typical accountancy firm to look after. So year-end accounts, bookkeeping, VAT returns, corporation tax, but we do take it one step further, whereby we do a lot of corporation tax planning, R&D reports, and financial due diligence. Henry, do you want to introduce yourself?
Yeah, so I'm Henry. I sit on the tax team, senior tax advisor here at Fusion Tax. A lot of my day job is advising individuals on tax efficiency, up-to-date legislation, and general planning for the future. So it's a bit of the past in compliance, but also about how we can optimize individuals' affairs for future endeavors or potentially future plans.
Okay, so we just run through the webinar agenda today. So we're going through the accounting basics, everything that your accountant should basically be telling you about, what you should know prior to your year-end passing, and any top tips that we do have. Likewise with corporation tax. Henry will cover the personal tax side, so anything in relation to your self-assessment returns. Henry, is there anything else that you're covering in personal tax?
I think that's basically it.
So as the tax year end is coming up in a couple of months, it's best to get the top advice from Henry in relation to your self-assessment return and what you can utilize in terms of tax reliefs. I'll also start talking about personal finance, just touching on that briefly because we do have financial advisors in-house in terms of Fusion, and likewise with corporate law. If anyone does have any questions throughout the course of the webinar, please feel free to drop it in the chat box. I'm trying to make this webinar quite interactive, so less formal. So I'll jump on the chat box and read out any questions that anyone does have throughout the webinar.
Great, and a bit about Fusion. So we are based in London. We've been running almost 7 years now, and we employ about 35 staff. We have a lot of offering lines, particularly small, medium-sized enterprises, entrepreneurs, private clients, as well as high net worths or anyone who is an option of high net worth. Our team includes in-house advisors, so we all work in one, hence the name Fusion. We all work in tandem, so we deliver a service that involves, say, if it's tax and accountancy and financial, we all work in tandem together. So we are all specialists in our own particular area. I'll let Venetia talk a bit about financial accountancy and the offers they provide.
Yeah, so you'll see on that chart there that Fusion is a 360 group. So we offer a number of different services, as Henry just mentioned. So my team look after the accountancy side, listed out everything that our team could do for you in terms of the accountancy, but obviously the scope for accountancy is quite wide. We're not your typical accountants whereby we just send you your year-end accounts right at the very last minute, hence why we're running this webinar. So my team work quite closely with the financial guys or the digital guys or the tax guys, so Henry's team, just to help you save in terms of corporation tax, save in terms of personal tax, but also ensure that your personal finance is in the best position that it possibly can be. So running through the top accountancy tips that my team tend to speak to clients about. A lot of the time we are registering clients in terms of HMRC applications, so VAT, PAYE, CIS. Henry, are there any other registrations that we complete with HMRC in terms of just taxes?
Yeah, I mean, registering individuals, self-assessment, of course, corporation, partnerships and companies, and yeah, a whole host.
So what we find is that clients tend to register with HMRC themselves. This can typically cause quite a lot of delays. And the reason why clients choose to register with HMRC themselves is purely because they want to save in terms of fees. We are actually HMRC agents, so we are agents with HMRC, and any other accountancy firm would be an agent with HMRC. And the typical wait time with HMRC right now is about 4 weeks to ensure that an application is going through. So, for example, if a client is carrying out the application themselves and they make an error on that form, and the form does get rejected, they will have to wait 4 weeks for HMRC to essentially write them a letter stating this is now being rejected. So you're essentially starting that process all over again, which is quite delaying in terms of actually applying for taxes. So, for example, if you're doing a self-assessment return and you've left it to the very last minute to obtain a UTR, it's likely that you will miss the deadline to file your self-assessment return purely because you don't have the UTR in place. Henry, I assume you've had a number of different cases recently, having just completed the end of years in terms of taxes. What are the implications of a client registering quite late with HMRC?
Yeah, and it's a really important point, Felicia, because I think there's a deadline whereby if you had a final requirement, let's say you were self-employed or you realized a lot of capital gains in a particular tax year, there's a deadline to notify HMRC that you need to file a tax return. So that deadline is 6 months after the end of the tax year. So it's not, although we will always try and get everyone registered as soon as possible, if you've waited until January to even notify HMRC that you need to file a tax return for the previous tax year, not least will you miss the deadline, you also will be late in notifying HMRC that you have that final requirement. So of course, you open yourself up to penalties, potentially interest, and all of this could have been mitigated had we known just a little bit sooner.
Yeah. So a typical question that we do get asked quite regularly is what are the implications of buying a car through the company? And electric cars are incredibly popular at the moment. A lot of people have their own opinions in relation to electric cars, but when it comes to corporation tax and the capital allowance benefits of an electric car, they hugely outweigh any of the drawbacks. So, for example, you can put through the full cost of an electric car through the company, obtain capital allowances of the car against your corporation tax, which can significantly reduce your tax liability at the end of the year. Alternatively, you could lease the vehicle, and depending on what the balance is in relation to business use and personal use, that cost can be put through the company. So it's worth speaking to your accountant or your tax advisor in relation to actually putting through an electric car through the company or just cars in general. Just a note on electric cars, the P11D benefit, I believe, is around currently 2%. If you have a different vehicle, for example, it's likely to be around 35%. So there is a significant difference in terms of P11D benefits on electric cars or just cars in general. Do you have anything to add in relation to cars?
Yeah, and I think broadly, this is all part of the government's intention, obviously, to go net zero by the end of the next decade. So, of course, we want to make sure that the government is incentivizing people to get electric cars. And one way to do that is through the tax legislation. So that's definitely the reason behind it. As Benicia says, regardless of your preference towards electric vehicles, it's one of the most tax efficient things you can do.
So moving on to utilising cloud-based accounting tools, we're a zero firm. So with the introduction of Making Tax Digital, a lot of clients and a lot of limited companies do need to move to cloud-based software. We've essentially migrated all of our clients to cloud-based software, Xero being our chosen piece of software. I'm sure in terms of self-assessment, that is slowly moving to Making Tax Digital, though I'm sure HMRC haven't really released anything additional in relation to that, Henry.
Yeah, absolutely. It's always been pushed back, and the pandemic and whatnot has certainly put delays on that. But again, it's always around the corner, and it's something everyone should be mindful of.
So one of the reasons why we do choose Xero is purely because We can obtain a direct bank feed from clients. There's different apps that you can use with Xero. So for example, an OCR scanning app, mobile phone apps, and it means that we can retrieve client data quite easily. It also means that clients don't need to keep any paper in their offices. They don't need to send us information in terms of spreadsheets or banking information. We have direct access to their accounts. So we could turn around to a client and say, actually, I've noticed you've spent £20,000 here. Did you know that your corporation tax benefit or the effects in relation to tax is X, Y, and Z? So it allows us to actually utilize that data and help clients in a more proactive way. I do highly suggest having a meeting with your client, a meeting with your accountant a few months before your year end. Likewise, don't leave drafting your year end accounts until the last minute. You could potentially have late filing penalties with HMRC or Companies House, or you could have a corporation tax liability that you didn't expect and essentially need to pay HMRC that balance, and interest can accrue. The reason why I state have a meeting with your accountant a couple of months before your year end is purely because, one, you want to ensure that you're utilizing any of the tax reliefs that you can within that financial year. So I'll move on in a couple of slides in relation to personal finance, but you can put through pension contributions through your company, which can essentially reduce your corporation tax. And as long as those pension contributions are made within that financial year, you essentially have the benefit. There's always the question of salary versus dividend. So we just want to ensure that all directors are utilising their personal allowance. What we have found is that a number of directors don't actually put through a director's only salary within the company, and they purely take everything as a dividend. The problem with taking everything as a dividend within the company is if, for example, you leave your accounts so late up until the very last minute to file the accounts, or you haven't had that meeting with your accountant prior to your year-end passing, you may have an overdrawn director's loan account, which could essentially move your corporation tax to a much higher rate in terms of Section 455. So we do advise clients do take a basic director salary, which you should be working with your accountant to calculate how much you should be taking. Likewise, you should be working with your tax team if they are drafting your self-assessment return. So do you have any thoughts in relation to salary versus dividend? Because that's a question that we do get asked quite regularly.
Yeah, absolutely. We'll cover it more on the personal tax side, but yes, it is always the tricky question. Everyone's situation is going to be unique. So maybe one of your friends, family members do won't necessarily be the best for you. And of course, tax rates are going up from the 6th of April, 2023. So yeah, what might have worked previously or what might have been better previously might not be the case. So yeah, we'll have a look at that on the personal tax side later on.
So this last point might be fairly obvious, but you'd be surprised how many directors put through personal expenses through their company. Now, whilst you can put personal expenses through the company in terms of a director's loan account, you just need to ensure that that balance always does need to be paid back before the year end. If it's not paid back and it's not covered through a dividend, i.e. if you don't have sufficient reserves within the company, you're liable to pay Section 455, which I believe is around 32.5% at the moment, which is quite a significant tax to pay. So that's one thing that you want to avoid. Just ensure that your personal and business finances are kept completely separate. Your company bank account is not your personal bank account, so just keep them completely separate. So I've already discussed pension contributions through the companies quite briefly. We work with our financial guys here internally, and making pension contributions through the company is a great way to reduce your corporation tax. Payment does need to be made before your year end does pass in order to obtain any benefit through the corporation tax. But I'll touch on that again in a couple of slides. Likewise, I've mentioned taking a director only salary. It's just ensuring that you're utilising your personal allowance throughout the year. Most directors and most employees do make business trips, so ensuring that you're claiming the relevant amounts in terms of claiming business mileage. I think it's about 10,000 miles at the moment at 45p, and just ensuring that that is also going through the company. So anything like that can help reduce your corporation tax purely because it's a cost that you're putting through your P&L. So with a lot more members of staff and a lot more directors working from home or giving up their offices in terms of rentals and actually utilising a home office, Work from home allowance has started to become quite a big thing in terms of limited companies. So the rate at the moment that we're putting through in terms of directors is £6 a week. So that should cover additional costs such as heating, lighting and internet access. Anything that HMRC do deem as relevant to the business over and above the £6 could be looked into by your accountants in terms of putting that within the company. Do you have any thoughts in relation to any of those points additionally in terms of also reducing your corporation tax, Henry?
Yeah, I think that's kind of the tip of the iceberg. Obviously, there's a lot more which we can look at, and for every business they have their own unique situation, so we can look at that. But yeah, certainly I would say the work from home one has been a big COVID sort of expense everyone now is only aware of. So it's of course things do change, but it's always interesting to see staff parties as well. Very important.
Yeah, so with staff parties, you have £150 per head that you can utilise for staff parties. Doesn't necessarily have to be a Christmas party. As long as you're entertaining your staff and it's through a party, £150 per head is currently allowable by HMRC through your company. It's a great way to reward your staff and just thank them for any hard work throughout the year. But it's also a perk to put through the company as well. Likewise, with any subscription costs, subscription or training costs. So if your members of staff are, qualified accountants like we are, those costs can be put through the company. But if your company doesn't pay for it, you can also put it through your self-assessment return. Is that correct, Henry?
That's correct, yeah. And if you're a nurse or a doctor, you have professional bodies and indemnity through your professional bodies, then all of that kind of stuff you can claim. Don't necessarily need to file a tax return for it, but if you do, it's important we include those.
And also ensuring that you're paying HMRC early. As much as everyone hates paying HMRC, ensuring that HMRC are actually paid on time avoids any late payment interest or any of those debt letters that clients do obtain when they've passed a certain amount of time in terms of paying HMRC. So just ensure that your corporation tax, self-assessment, PAYE, VAT, all of your taxes are paid on time to avoid any unnecessary interest. So moving on to corporation tax, this is quite a big area and it's an area that we get asked quite a lot in terms of our clients. So having that bill at the end of the year end or the 9 months and 1 day where you actually have to pay the corporation tax is quite daunting for a number of clients. So ensuring that, as I mentioned before, having that meeting with your accountant prior to your year end and try and get a corporation tax liability provision from them. At least then you've got an idea in your head as to what your corporation tax is likely to be. Just also bear in mind corporation tax is increasing to about 25%. It's from the 1st of April 2023. So utilising capital allowances. So the annual investment allowance at the moment has increased to £1 million. That essentially means companies are allowed to invest £1 million in plant, property, machinery, equipment. And that £1 million can be offset against your corporation tax liability. Usually assets are actually placed on the balance sheet, so that actually doesn't affect your corporation tax because corporation tax is based on your profits. But HMRC have allowed the £1 million on any asset purchases to be offset against corporation tax. So capital allowances are definitely an area that you should be looking at, especially if you're doing something like an office fit out or upgrading any of the equipment within your offices for staff. Utilise that capital allowance band now because that's I believe that's a temporary increase by HMRC, and with the new rates and new rules coming out relatively soon, we don't know if HMRC are then going to reduce that £1 million back down to, I believe it was 250,000 a couple of years back. Likewise with new commercial buildings, I'm sure Henry can touch upon this point because his team does a lot of property work. So you can claim a 3% straight line writing down allowance on new commercial buildings. So a lot of our clients are property investors or looking to invest in property. So that is a good capital allowance that you can obtain if you are within the property sector. Henry, do you have anything additional to add in relation to that?
Yeah. Exactly, Venetia is right. We see that a lot, and of course, for some people, this can really make the difference, depending on whether or not they're going to buy or lease a building, and claim that 3% deduction. It's clearly very generous. And of course, you can claim that over a long period of time. So it's a very good relief, and also it's very advantageous. And all of this, again, to incentivize investment in, obviously, businesses and property. So these are all the sort of typical things we see here on Fusion Tax.
So it's just ensuring that you're reviewing any of your expenditure throughout the year to determine what actually qualifies for capital allowances. So your accountant or your tax advisor should be assisting you to run through any of the expenses, any of the assets, and just ensuring that they're correctly claimed capital allowances. So another area that you can reduce your corporation tax, and I think this is Henry's area, is share schemes. So Henry, do you just want to run through how share schemes work?
Yeah, so broadly speaking, there are two types of share schemes. There's the tax advantaged ones and non-tax advantaged ones. What that means is non-tax advantaged. Of course, there's nothing legally stopping you from setting up a share scheme. It's just whether or not your share scheme qualifies for tax relief. So you can have one, and most companies do have one that isn't tax incentivized. That doesn't mean it's not good for you as an employee or to incentivize you to work from an employer's perspective. It just means that there's no additional tax relief. But yes, typically EMI is a very classic one for a qualifying tax advantage share scheme. So it's making sure that not only are you rewarded for your longevity and your service to a company, it's also about making sure you're taxed at a lower rate than if you were just ordinarily given cash as a bonus. So it's about employee participation in a business, and HMRC give corporations very preferential tax write-offs for incentivizing or participation from employees.
There's also ensuring that you're claiming all of the available loss reliefs. So, for example, if your company made a loss in the prior year, you can offset that loss against future profits. Or if you've made a loss in the current year in terms of corporation tax, you can offset that loss. You can essentially take that loss back to the prior year if you made a profit in the prior year. So it's just utilizing different loss reliefs available and just doing some sort of tax planning around that, which again, your accountant or your tax advisor should be able to calculate for you relatively easily. R&D tax relief is an area that we're quite big on here at Fusion. We've done a number of webinars around R&D tax relief. So I'm just going to touch on it very briefly. So R&D tax relief is essentially if you're investing in a new product or have a new process that you've incorporated within your company. So it's not just someone standing there in a white coat in a lab, just designing a product or creating a product. The scope for R&D is relatively wide. So you can actually arrange a free consultation with me if you did want to discuss any of the tax reliefs that are on the screen available to limited companies. Likewise with group structures, we do a lot of group structuring work here at Fusion. So Henry and I work quite closely together in terms of the group structuring and ensuring that if you do have a number of different companies that you're utilizing any available tax relief. So putting in place a holding company and then subsidiaries just underneath, and the different tax benefits that are available to that group company. So Henry, do you just want to talk through some of the tax benefits that are available to group companies?
Yeah, it's probably one of my favorite, definitely one of my favorite type of tax relief. So using a group to essentially, you can subsidize other companies through one company. Let's say you have a trading company, setting up maybe a parent company to own that trading company, all of which are ultimately owned by the same individual or individuals, just allows sort of other ventures that you may, say if you want to invest in property, you can look into a property company and have that part of the structure. So what it allows you to do, and it enables individuals who own businesses, is using a corporate group structure to essentially move losses, if there are some, against profits in other entities. And also, if you say want to sell your business, which is a very key point, if you didn't have the group structure, let's say you had a 100% ownership in your trading company owned by a holding company, you wouldn't have to pay corporation tax or capital gains tax on the sale of that trading entity. It would just go up to the group structure. Of course, eventually the profits will have to be withdrawn and there'll be a dividend tax, but it allows you to live in a relatively tax free environment to invest in other ventures you may have. Of course, all of this we can explore in more detail, but the tax on for instance, the savings of using these types of structures far exceed the cost of the advice that would be required to set these types of structures up.
Yeah. So what we have found is, so for example, we have a group of companies. We've recently done this for a number of our clients, whereby they've had two companies completely separate in terms of trade, and they wanted to ensure that they were either loaning the companies money in the most tax efficient way, or ensuring that the group itself was protected and utilizing all of the corporation tax benefits available. So what we had actually completed was a holdco structure, so a holding company at the top and the two subsidiaries at the bottom, and the holding company would own the shares of the two subsidiaries. And that obviously needs HMRC clearance, which is where Henry's team does all of the work in terms of the report, etc., and getting clearance from HMRC, whereby my team would look after the accountancy side and ensuring that you're utilizing all of the corporation tax benefits. So that's definitely a good way to essentially just move your companies into one group and just make it slightly neater, and just making sure that you're utilizing all of your tax reliefs available. So that's definitely something to think about if you have more than more than one company, I'd say.
Absolutely.
So Henry, do you want to discuss the different points in terms of personal tax and ways in which clients and directors or individuals can help save tax in terms of self-assessment?
Absolutely. Thanks, Manisha. We'll do a quick whistle-stop tour because I think there's a lot. Obviously, this is pretty much just the summary of the types of things as an entrepreneur or as a business owner you want to think about. But also, if you're just let's say maybe a self-employed person or maybe even salaried, there's a lot of potential planning opportunities, but also pitfalls that I often see. Typically when let's say you have a family accountant or a friend does your tax return, they're often, the rules change very often. The rules almost change every year. Of course, in recent years, a lot has changed, and with the pandemic, there's been a lot of tax rule changes. So it's important to always make sure that your advisor is abridged in all of the nuance that is involved with personal tax, because unfortunately, once the tax year is said and done, there are very few planning opportunities you can do as once the year is up. So the current tax year we're in ends on the 5th of April 2023. You have 1 month and 2 weeks to get your affairs in order, to basically make sure you're as compliant and paying as little tax as possible before the end of the tax year. So a couple of points I like to highlight. So dividend allowance. So every dividend allowance, personal allowance, annual exemption, these are all use it or lose it. So if you do not have any dividends from, let's say you own a company and you haven't drawn any dividends, you get £2,000 tax-free dividend allowance that you can draw from your company. And if you don't do that, on the 6th of April, that allowance is going to decrease. It's going to be £1,000, and then the year after it's going to be £500. So not only you're losing that £2,000, you're also going to start getting less and less dividend allowance going forward. As well, personal allowance, let's say, again, you're an entrepreneur or you own a business and you haven't drawn any drawings in the form of dividends or salary. If you haven't used your personal allowance, again, use it or lose it. If you don't have any taxable income for the tax year, great, you won't pay any tax, but equally you could have drawn £2,500 in salary, for example, and not paid any tax on it anyway. So it's always about thinking, now is the time to think about, are you efficient? Are you using all your reliefs? And have you optimized your affairs in such a way that means that when it comes to 6th of April, you're not going to be worried about, am I paying too much tax? Or should I be doing something with my company to draw money from it? So furthermore, if you one of the advantages that you can have as, let's say, if you're a business owner, is integrating your family or spouse into the company or into your business to try and pay them either a salary or a dividend. Again, let's say the dividend allowance, you're both entitled, if you and your spouse or civil partner are UK residents and taxpayers, you both get this dividend allowance anyway. So you're missing out by not thinking about these things before the end of the tax year. So I like to always advise clients when we look at let's say we're looking at a set of circumstances, you want some tax advice. We don't just look at you as an individual. We try and assess the family, the wishes of the family. We try and integrate because the more people we can include and the further into the future we can look, the better it's going to be for tax, and also the better it's going to be for your personal tax situation. Rather than drawing £12,000 in your name paying 40% tax, maybe it makes sense to do, maybe your spouse who's a non-taxpayer, pay them the 12,000, not pay any tax. So your marital tax bill is lower.
I think just adding to that, one of the areas that we do find clients approaching us about is actually future tax planning. So they want to be in a certain place in 3, 6, 9 or 12 months. What you'll find is that a lot of advisors will just look at your past data. So look at the data that has happened over the past 12 months. They don't really look into the future as to what you should be doing to get yourself to a certain place. So the reason why Henry and I work together quite closely is because I work on a lot of limited companies, but a lot of the time those limited companies, the directors are actually clients of Henry's as well. So it's really utilizing any of those allowances like Henry mentioned. So for example, the dividend allowance, and it's ensuring that clients are aware that in the next 2 to 3 years, that dividend allowance is going to reduce. So utilize your dividend allowance now, otherwise you're just going to lose it in the future.
Exactly right. And it often, the entertainment part of my day is you're essentially looking at 3 different timelines. You're looking at past, present, and future. Of course, depending on the time of year, one of those 3 quadrants or one of those 3 timelines is more important than the other. But for instance, when it's tax filing season, we look at the past, what's happened. When you are coming to the end of the tax year, we want to look at today. Before the end of the tax year, we want to plan. And then maybe after the tax year, you want to think about the future. What is my next year's tax bill going to look like? Let's say you are thinking of buying property and you need a deposit and you want to draw money out of your company to pay for a deposit. You need to think long term about that, because it maybe wouldn't make sense to take a bunch of money out, pay a hefty amount of dividend tax or income tax on your salary, and then only to find that your tax bill is increasing because you didn't straddle it over 2 tax years, for example. So there's often this juggling act where you're looking at all 3 past, present, and future in one go, and it could be a bit. It's always important to think all of them because they're all equally important. But thankfully, today we're going to be talking about what we can do before the end of the tax year. And again, furthermore, workplace pensions and private contributions. You'll be surprised. Everyone in the UK is also, if you're earning in excess of a certain amount and working full time, everyone is also enrolled. But are you maxing out your pension contributions? Are you let's say you're on the cusp, you earn £99,000, you're about to earn, let's say, £110,000 next tax year, or you're about to get a bonus. Maybe it makes sense to lower your taxable income so that you're paying, let's say, the effective tax rate for people who earn between £100,000 and £125,000 is about 60%. As well, you need to think about lowering your taxable income before the end of the tax year, because again, once the tax year is passed, we won't be able to do much in terms of lowering that to utilize preferential tax reliefs such as the pension contribution. So private pension, what I will also add to that actually is, and Venetia probably sees this a lot, is having a company pension scheme is probably one of the best things you could do, because not only are you not paying corporation tax on those pension contributions to the employees or directors. You're also benefiting from not having to pay national insurance contributions when you pay a salary. You have to the employer pays national insurance and the employee pays national insurance. So by making this pension contribution directly, you're cutting out the middleman and saving yourself a bunch of tax in the process. And I'm sure
it's a win-win.
It's a win-win, and it makes, you'll probably find that if you have the money to do so, we would always recommend maxing out your pension, or at least considering it as part of your tax strategy, because you're getting free money, tax-free growth. Yes, there's some tax on the way up, but it's important that we look at that over the long run, because ultimately, this is how the pensions are, from a policy level, how they're incentivized. So regular gifts out of income. So we're moving on a bit, looking more at inheritance tax. So at the end of maybe this is something that your accountant isn't so familiar with, but let's say you're worried about your inheritance tax liability. So right now, inheritance tax is 40%, and people need to consider how they can lower their estate in order to not pay 40%, because ultimately, when an individual passes away, what happens afterwards can really make the difference for the beneficiaries of that estate. And paying 40% tax can really change the kind of quality of life that the beneficiaries could potentially have. So gifts out of income is a bit of a niche point, because what it looks at is, can you give money on a frequent basis to a beneficiary? And if you can, let's say your lifestyle expenses and cost is £2,000 per month, and you make £4,000 per month, you can give up to £2,000 of your income without the detriment to your quality of life, and it will be inheritance tax free. So you can give. It's all with inheritance tax planning. It's all about looking at the long run and on a longitudinal basis. So you can give more and more of your money. Let's say you don't need the money and you want your grandchildren or your siblings to benefit from this, then we need to start acting now and build a structure where we can not only advise you on your individual personal tax situation, but also think about the future. Again, not everyone likes to think about death, but it is a necessary part of life. And we need to think about what can we do to lower your estate tax or your death tax, and also what can we do to lower your estate for IHT. And I'm sure no one likes to talk about death, but we do need to, as part of my job, we advise clients on a frequent basis. Life insurance obviously is one option you can have, but there are other options on the table other than just, let's say you're 75 years old, you might not, the premiums of getting life insurance might far exceed the benefit of taking out that insurance policy in the first place. So we need to think about that, and we also need to think about what we can do to advise our clients on a better outcome that is not only just better from the tax point, it's also about not letting the tail wag the dog, thinking about how can your lifestyle, living your best life, and having a trusted advisor to think about these things, such as Venetia or I. And lastly, I'd just like to draw your attention to family investment vehicles. So we kind of mentioned it a bit with holding companies, but what it comes down to is looking at having a structure, corporate entity that, or structure of companies, let's say a holding company and some other structures to hold assets, usually luxury items, if you're fortunate enough to have those, and do it in a, not just from an inheritance tax point of view, but also having these structures so that you can have your assets quite clearly out of your name, so you don't have to worry about inheritance tax. But also, if you want your children or grandchildren or other people to benefit from these assets, to set up share classes and things like that. But I'm sure Venetia has lots of experience and can talk a bit about family investment vehicles and the sort of benefits there.
Yeah, I mean, there are a number of benefits in terms of family investment vehicles. Henry's touched on the majority of those benefits. It's essentially, so for example, if you wanted to invest in Rolexes, for example, what we've had is we've also had companies or directors that have approached us, and they do have an investment company, and they want to utilize the group structure. So we have put in place a group structure whereby they've got the trading entities, the main trading entities, they've got the family investment vehicles as well, and like we mentioned, that's all fully protected in terms of the group structure, and it's received clearance from HMRC. So that's a big tick against that actual group structure, rather than just putting in place an informal group structure. It's a formal group structure where the entities are fully protected in terms of any taxes or any penalties that may be attributable to them. So Henry's touched on a lot in terms of the personal tax side. If you do have any questions in relation to personal tax, do drop them in the chat box. I'm sure Henry will be happy to answer any questions that you do have in relation to personal tax. So just moving on to personal finance. So this isn't either Henry or I's area of expertise. We do actually have financial advisors in-house, but we do work quite closely with the financial advisors. So for example, if you have a limited company, there are a number of different things that you can do within that limited company to essentially reduce that corporation tax, which, you know, for a lot of directors and a lot of shareholders and company owners, that's ultimately what they do want to do, reduce that corporation tax now. However, put in place different schemes or different options available to them for the future. So something like a pension, which we've discussed in quite a lot of detail throughout the course of the webinar, just ensuring that you're utilising any pension contributions that you can be making. So the guys within Fusion Financial can discuss with you how much you can contribute towards your pension and utilise your company to make those pension contributions. And that is a fully taxable benefit. So you can fully deduct that against your corporation tax, because essentially that just goes through your profit and loss account. Likewise, making any sort of tax efficient investments. So Henry touched on that within his slide. So tax efficient investment vehicles alongside any other investments. So our financial guys can speak to you about making investments either through your company or personally when the actual inflation rates are relatively high, or just ensuring that you're investing your money in the right place. Likewise, with any sort of protection, have you thought about health insurance, life insurance, ensuring that your will is in place, and just ensuring that all of the different protections are in place, whether that be through the company. So health insurance can be put through your company. It can also be offered to your members of staff. So PMI can be offered to your members of staff. Although it is a taxable benefit, it is a deduction in terms of corporation tax and profit and loss accounts. And it's also a great way of rewarding your staff and ensuring that that is an additional benefit on top of the salary package. Likewise, with life insurance, just making sure that you actually have that in place. So more legacy planning, ensuring that your will is in place, life insurance in place, speaking to someone like Henry to discuss any sort of inheritance tax or any other taxes. So just in terms of protection, Henry, what is your best advice? And I'm putting you on the spot here. What's your best advice for anyone that's thinking about protection and ensuring that their family or their loved ones are fully protected?
Yeah, I mean, what it comes down to ultimately is, let's say you have a family home worth £5 million that you don't want to sell, and you want to keep it in your, let's say, your legacy and your children and your children's children and so on. You know, when you get hit with a 40% inheritance tax liability, of course you get nil rate ban, residential nil rate ban, and there's those other reliefs like gifts out of income. But ultimately, it causes a liquidity crisis, because assets, when someone dies and there's no liquidity to cover the inheritance tax liability, because it's your, when an individual dies, it's the estate's liability, so the estate has to pay it, and they need to find the cash to do so. So if you say don't want to sell property, but you die, it forces a decision to sell if there's no liquidity. So what the folks at Fusion Financial can offer is protection. So looking at life insurance to cover, let's say you have a £2 million tax bill on your death, making sure you have a life insurance policy to cover that tax bill, but also so that when, let's say you gift an asset and you have 7 years before that gift is no longer in your death estate, for inheritance tax purposes, they can look at these tailored insurance products that tail off. So after 4 years, the value of the inheritance tax on any gifts decreases, which means that if you need insurance, the insurance can also cover you for a smaller and smaller amount. So it's called the belt and braces approach, which just basically means that we can make sure that any tax liability as a result of death, or let's say you gift a very high value item, you want to make sure that in the event of a death, you have the appropriate cover to meet any tax liabilities without forcing your beneficiaries to sell anything and realize liquidity. And as well, flash sales are never usually great. And it could result in losses, both economic losses, but also tax losses.
So just as a general overview, one of the ways that the accountancy team work with the financial guys is, for example, if we're looking after the limited company, a couple of months prior to the year end, I'll always speak to the financial guys and essentially run through the financials with them and just advise, and they would advise me as to one, is the company or are the directors, do they have a life insurance policy? Do they have a health insurance policy? Are they utilizing all of their pension contributions? So things like that, small things like that, whereby you wouldn't necessarily think about them on a daily basis, that essentially can reduce your corporation tax liability at the end of the year. And as long as you're having that meeting with your accountant prior to your year end, so 2 to 3 months prior to your year end, there's more than enough time to put those policies and contributions in place. So finally, moving on to corporate law. So we do a lot of corporate law work internally here. So we do have a fully qualified lawyer in-house, and she looks at different areas in terms of compliance. So ensuring that data protection laws and client expectations in terms of IT, cybersecurity space are all in place. So just ensuring that all of those policies are up to date and actually in place within your limited company. It's very much just ensuring that you're compliant with any regulations around the corporate law side. That's one area that a lot of clients do neglect. So also ensuring that your employment contracts are all up to date, adhering to the ACAS regulations, or just ensuring that you've got a clear contract in place and a staff handbook. So some of those key policies, many companies or many directors don't actually know that they need to have in place. So it's just setting out very clear rules and regulations around your contracts and your staff handbook, and just making sure that all of those policies are in place. The way in which law work quite closely with clients is, for example, if you are looking to sell the company in X number of years' time, you need to ensure that those policies are in place from now to also ensure that it passes, so that the company passes any sort of due diligence that it may have in the future. So our corporate law team also look at a number of different contracts, so corporate contracts, and just ensuring that they're clear and to the point and compliant and protecting the actual business itself. So one of their main focuses is protecting the business and protecting the director, and ensuring that the director is fully advised in relation to what they need to cover and what they need to tick when it comes to legal and law, so the legal and law side. Likewise, we're protecting any shareholders. So, for example, if we are doing something like a group structure, that's where the 4 teams would come together. So Henry would complete the clearance with HMRC. I'd do the accountancy side. Fusion Financial would then get involved in terms of pensions. But where law come in is just to ensure that the shareholders are actually protected. So do you have a shareholders agreement in place? Do you have a directors agreement in place? Is everything transparent, and is everything actually explained to each of the shareholders? It's things like that that you don't necessarily think of when you're setting up a company. So from the get-go, when we look at incorporating an entity, if there are 2 shareholders, we always advise that there is a shareholders agreement in place. that ensures that there's no ambiguity in relation to what the shareholders' responsibilities are, who has what, who's eligible for what dividend. So, Henry, do you have any thoughts in relation to corporate law? I know you haven't really touched on the law side because you're purely just so engrossed in tax, but I mean, just from a group structure point of view.
I think what it's about is making sense and not having, and I think ambiguity is a key driver of a lot of complaints, and especially, if you're, let's say you're, not well versed in tax law, or if you're not well versed in contract law, it's just about creating this favorable environment whereby you understand what it is you're doing. It's in plain English. We can understand the benefits. You can also understand the contractual legal obligations, because of course, with holding structures or with corporate entities, there's always going to be a legal side and a due diligence required. But I will say that from my side, it's incredible the amount of, I suppose, the complexity that can just be lost because people might not be able to understand it. So what we pride ourselves on here at Fusion is being able to explain that in simple terms, and also having a trusted advisor who can explain these things to you in plain English, and also you can have faith knowing that we are looking after these affairs and complying with all applicable laws and regulations.
So I think I've covered the majority of the questions that have come through the chat box throughout the course of the webinar. If anyone does have any more questions in relation to anything that we have discussed, or want to arrange a free consultation with myself or Henry or anyone from the team, so any of the financial guys, anyone from the legal team, my email address is listed just there, and I can pass it on to the relevant team. So again, just our contact details on the screen there. So you've got Henry's contact details. He's a senior tax advisor within Fusion Tax. You've got my contact details there as head of accountancy. You can contact me directly if you want to reach out to any of the financial guys, or if you want to have a discussion in relation to reducing corporation tax or your current services that you may have in place in terms of professional advisors. So thank you everyone for joining the webinar. Hopefully we'll see you on the next webinar, the next corporate webinar or the next personal tax webinar. And thanks for joining me, Henry.
Thank you guys, and thank you for listening.
Take care, everyone.